Hi, John Dobis from Forbes, talking with John Buckingham from The Prudent Speculator. Welcome to people on Facebook Live. We are live. What's the date today? August 25th, just to prove. We don't have a headline from a newspaper to hold up. But as you may know, John is the editor of probably the most successful investment newsletter over the past 30-year period now. He's been with them since '87, and we're talking about how to find stocks that are still cheap. John, I was looking at the Shiller CAPE ratio. You take the past 10 years of earnings and adjust for inflation, blah, blah, blah. We're at like 29.9 times last 10 years earnings on the CAPE ratio. Average is about 17.7 over the past century. That suggests massive overvaluation. Are you of the camp that says, yes, that we are very overvalued and you should probably be very worried or careful?
Well, I'm in the camp that it's a market of stocks and not a stock market. So there are many stocks that are overvalued and expensive, but there are also numerous companies that are inexpensively priced. And so here's where I think the merits of active management over a passive strategy makes sense. But if you look at the Shiller historical numbers, and we do study this, I have it in my presentation here at the show, believe it or not, back in 2000, which was sort of the last time we were at these levels and stocks, quote unquote, stocks were extremely expensive, that was an excellent time to be a value investor.
Sure.
Because there was a rotation out of the expensive stuff and into the inexpensive stuff. So I'm praying that we have another period like that, because the Russell 3000 value index was up over the next 5 years, something like 40% total. The Russell 3000 growth index was down like 40% total.
Well, you had a lot of oil stocks too in that.
We did.
Well, then again, oil's cheap again.
And we even had technology stocks back in those days that were inexpensively priced with lots of cash on their books. So I really hope that we have another market correction like we did in 2000, because that would be, gold for value investors, because that's where the money will. We're in this environment where yields are low, where
alternatives are not very good.
Alternatives are not very attractive. So where are you going to put your money? And people inevitably chase performance. And if value starts to perform, that's where the dollars will gravitate toward. And frankly, there's been so much money that's stampeded to the other side of the boat, the growth side, that if we just got a little bit of it coming back toward value, I think you have substantial outperformance opportunities.
The last major tide change in interest rates occurred when you were a very high-performing middle schooler, probably, and maybe high schooler at that point, I don't know, 1981, And I've looked at charts, and every 36 years it seems the tide seems to change, and we're kind of due for a change. And I know people have been saying that for many years now, that interest rates have nowhere to go but up. It's almost a cliche. One, do you think that interest rates are due to take off? And two, if they do you think that would be like garlic to a vampire for the stock market?
Well, I think it would be a positive for equities in general. History, and this is the fascinating thing, if you actually do the analysis and look at the data, previous times the Fed has initiated a rate tightening cycle 17 times, value stocks have done extraordinarily well over the exceeding 2, 3, and 5 years. So equities in general have done just fine in a rising rate environment. Frankly, my belief is that value has done poorly over the last decade or so because of the falling interest rate environment.
And growth is so scarce to come by.
Well, right.
And
so people are willing to overpay for growth. And your point about fixed income is also interesting in that the bond market has attracted all of these dollars. It's fascinating that you look at investor sentiment data and you say, well, stocks trading near all-time highs, that must mean that everybody's optimistic. Well, if you look at things like American Association of Individual Investors, they're pessimistic.
Right.
They're not. It's not that they're neutral. They're pessimistic.
Right.
And you look at mutual fund and ETF flows. People are pulling money out of stocks and dumping it into bonds, even with the ridiculously low yields. So I would argue that as interest rates start to rise, and people get less excited about the returns they're getting on bonds, they're going to gravitate back toward equities.
Ring that sponge and the bond market dollars will just fall out and maybe into stocks.
Well, the yields are certainly better on stocks in many instances than they are on bonds.
This is true. John Buckingham, thanks a lot.